Hi, welcome to Money Confidence. I'm Crystal Oculi, the Chief Financial Strategist here at Confidence Wealth. And every week I try to talk about a topic that seems to be on everyone's mind. And this week I noticed that the definition of certain tax titles of accounts seem to get confusing for people. So I wanted to address that. So there's really three buckets that we have. It's called taxable, tax deferred, and tax free. So let's define what each of these buckets mean. So taxable, for example, even though it's called taxable, a lot of times people think that's what the 401k is. No, because 401k, we're not paying taxes on it every single year unless we're utilizing the money. So taxable means money that you have paid taxes on the principal. So let's say maybe you have some stocks that you bought with your after-tax money, or you have a CD or a savings account. When you earn interest on those accounts every single year, those interests is taxable. So hence why it's called a taxable account. Not the principal, but the gains, which then are, basically taxed at capital gains, right? So that's what taxable means. Then what we've got is the tax deferred bucket. The tax deferred bucket consists of all of your retirement funds, anything you deferred that you have not paid taxes on. So example, when you're working and you're putting money towards your 401k, you're not paying any taxes on it right now, you're deferring the taxes. So at some point you have to pay taxes on it. That's why it's called deferred. So again, that includes 401k, 403bs, 457s, thrift savings plan for some people, IRA money. So that's like a combination of all retirement funds. Then you've got your tax-free bucket. So your tax-free bucket consists of money that you are growing fully tax-free. This doesn't mean when you own municipal bonds, that's an actual investment that you have, that depending on if it's held in the taxable account, you're getting a break and you're not paying taxes on the municipal bonds, but it still shows up on your tax returns because it still affects your income, still affects your Social Security, how it gets taxed, it still affects how your Medicare is taxed. So definition of tax-free means truly tax-free. So that includes your Roth IRA, for example. So you went ahead and put money towards your Roth IRA, or maybe you took an IRA and you converted it, and now it's been over 5 years and it's growing. So whatever you started it with and whatever it is now. So let's say if you started with 50,000, now it's 150,000 all these years later. You never pay taxes on any of it. And it does not cause any other taxation on your tax returns, such as Medicare issues, where you may go to the next level, or Social Security taxes. It just does not even show up on your tax returns. That's a definition of truly tax-free. Another thing that it could actually be part of the tax-free could be maybe some life insurances that you may have, that you have built some cash value and you're borrowing against that cash value. So again, it's not showing up on your tax returns because you truly are taking it and it's tax-free. Of course, if these are utilized the right way, because they're a little bit more complex than a Roth IRA and have to be set up the right way to be utilized that way. But I just wanted you to understand the definition between these three buckets, because I find that a lot of times people get confused. So hopefully this has been helpful to you. If you have any other questions or want some clarity, don't hesitate to reach out to us. Have a good one.